Welcome back. We are awaiting a decision on interest rates from the Bank of Canada. That is coming tomorrow, and it's coming at an interesting time. In the U.S., there's been increasing talk about whether or not we see interest rate cuts at all this year because of a resilient U.S. economy. James Bullard, a former Fed official, pushing back on that today, arguing that the Fed has said they're going to cut rates, so you should trust that they're going to cut rates. Now, for Canada, obviously watching what's happening with the Fed is important. The challenge for Canada is whether or not our economic story is parallel to the U.S. Take last Friday's jobs reports, where we saw a hotter than expected employment picture stateside and a weaker than expected jobs market in Canada. Let's get a preview of what to expect with tomorrow's decision and beyond. Joining us here in studio is Francis Fong, Managing Director and Senior Economist at TD Economics. Nice to see you.
Pleasure to be here, John.
Okay, so what are you watching for tomorrow?
Yeah, I don't think anyone admires the Bank of Canada's position right now. I mean, anywhere you look, you could find evidence and argue in favor of cuts or starting them, as soon as possible. And then you could find evidence sort of delaying the hikes. You brought up James Bullard, the comment that he made. I think the point here, and I'm glad you brought that up, because, regardless of how strong or how much resilience we're seeing in the U.S. economy, that doesn't necessarily argue in favor of never seeing any cuts this year, because the reality is that with neutral rates where they are, you would still argue that we don't need as restrictive monetary policy as we do either in Canada or the U.S. And certainly in Canada, with the data that we're seeing both in the labor market, in GDP growth, and in other areas of the economy, looking at inflation, the trajectory of things going on there, it definitely still argues in favor of cuts later this year during the summer.
Yeah, I guess I don't know what we hang our hat on other than inflation, which is that it seems like the loudest of those who are concerned about rate cuts is that we're not at the finish line on inflation. Again, the U.S. and Canada stories are different, so I'm going to sort of blend them together and say, what do you see when you look at the charts on inflation right now?
For sure, yeah. I mean, you can look at the headline numbers, you can look at the core numbers. They're still arguing in favor of keeping rates higher than they are. But the argument is actually a little bit circular in that sense, because if you look at for something like CPI ex shelter arguably driven by high interest rates themselves.
Right.
CPI ex shelter is only running at around 1.3%. So the actual, other stuff in the economy, if you will, is coming down quite a lot. And it's that shelter component, mortgage interest costs, rent, replacement costs. That's what's keeping it afloat. So in a sense, you could argue that rates being high themselves is what's causing high inflation. But then on the same token, if you look at what the Bank of Canada might be looking at, their time horizon is also shifting out, because you're looking at 2024, 2025, the bulk of mortgage renewals are going to be happening in those years. So borrowers are going to be renewing into those higher rates. That's going to be putting downward pressure on the economy. And so, you might anticipate that they're going to want to predict the path of monetary policy in order to sort of mitigate that sort of downward impact on growth.
Yeah, you hear that a lot. A lot of mortgage renewals coming up for Canada's homeowners, and what ultimately that means for the economy if rates are at their current level. The other thing I've heard recently is people saying, well, if there's anticipation that people want to get back into the housing market and they haven't been in the housing market because of higher interest rates, they're just waiting for that signal of lower rates to jump back in, and then that creates some complications. And I know it's a complicated file because you mentioned there was inflationary impacts in the housing market from higher interest rates, but we're talking more about the worry about just people getting into the home market and the inflation that comes from that as well. Is it a concern to you?
Certainly, I think that's the case. I think it's the case for everyone that's thinking about getting into the housing market.
Yeah.
Prices where they are, even with interest rates at 5%, I still think a lot of folks, didn't quite see the downward impact on prices that you might anticipate given that level of interest rates. And the reality is that, to that point, there's still a lot of fundamentals back in the housing market, chief of which is population growth.
Yeah, sure.
Obviously, we got to talk about that. It's what's driving the labor market as well. But that fundamental demand for housing is sort of keeping things aloft. And so when you combine not enough downward pressure on prices with still high interest rates, certainly I think a lot of borrowers are still sitting on the sidelines. But then that's also the point, that there are still gainfully employed Canadians that are waiting for prices to jump in, which incidentally also puts a bit of a floor on housing prices, because the instant there's a drop in interest rates, a drop in prices that makes things even remotely affordable, people are jumping back into that hot spring markets, and suddenly we're back to where we were, during the pandemic when prices were going back up.
I think we're back where we were when we started this conversation, which is that there's a dance that these central bankers are doing, and we're trying to interpret where they might go, and they might just not know. They have to watch the data. But it is interesting that you did have some pretty clear messaging from the U.S. Fed on a path for rates. We talked about that earlier. You got a former Fed official saying, don't listen to me, listen to what the Fed has said. Now, the Bank of Canada has been quite reluctant to say anything about the path ahead on rates, other than to say we've likely hit our peak level in rates. Would you be looking for an update on the language tomorrow, outside of, whether or not they surprise everybody and make a change on policy?
John, we'll be looking for it. I don't think we're going to get it.
Okay. Okay. How come?
And I think that's mainly because they're going to hedge. They're going to hedge as much as they possibly can to leave themselves room just in case things don't go the way they think. And I think to point, just to drive home that point,
sure.
I made a comment earlier about, you can look at different points in data and support any kind of stance you want. And the reality is that there's a lot more resilience even in the Canadian economy than you might think. Wage gains still relatively strong. The retail sales data we got the other day, also really strong. A lot of fundamentals will point to the idea that if the Bank of Canada releases the brakes too soon, you could potentially see a resurgence in growth and inflation. And I think they want to hedge against that just a little bit.
Okay, we're almost out of time, but you're not expecting a change in rates tomorrow. You're not expecting too much guidance from the Bank of Canada. Are you expecting interest rate cuts for the Canadian economy this year? We
are. I think we've certainly followed market pricing as well, that we're still anticipating the first rate cut. Just to drive home that earlier point, we don't need rates as restrictive as they are.
Right.
So we still think it's reasonable to cut in the summer, but the pace of cuts will likely be slower than I think a lot of folks are anticipating. Certainly markets are pricing that in as well.